Welcome to all investors and other interested parties in the SavInvest India Asia Fund. Today, we do a first in a series of webinars to keep you informed as to what is happening with this fund, your fund, the SavInvest India Asia Fund. Today, we will be doing a presentation which will be done by our investment manager or manager investments, Sarod Ramkalawa. Subsequent to the presentation, we will answer questions which you would have posted during the presentation. And thereafter, we will take questions on a one-to-one basis, which you would not have had time to send in, so that we can deal with these questions at a later time. My name is Subhash Ramkalawan, Managing Director of Bourse Securities, and I turn you over now to our presenter, Sarod Ramkalawan, Manager Investments.
Good day everyone, and welcome again to this webinar which is focused on the SavInvest India Asia Fund. And today we have several items on our agenda as we go through the performance of the fund and address investor issues and concerns, as well as provide some outlook for the future performance of the fund. Again, in terms of the agenda, we'll quickly cover some of the fund highlights year to date thus far. We take a look at the performance year to date as well as in its recent history. We also look at how the fund is allocated in terms of asset allocation and where the fund is invested in terms of geographic allocation. We also consider market performance of some of the anchor investment destination of the fund, that is India, as well as other major jurisdictions of the fund's investments. In addition to market performance, we take a look at the economic performance of the region. And Asia is and continues to be one of the strongest performing economic regions across the world. We also consider the outlook for the Asian region, including drivers to performance of economies and markets, as well as some potential risks to performance of markets and economies. And finally, we will touch on the investment management initiatives which are being undertaken to ensure that the most value is added to you, our unit holders, and your investment. And finally, we will conclude with a question and answer session where we will address some of the questions posed by our attendees during this webinar. And again, in the lower right-hand portion of your screen, there is the chat, the moderated chat, where you can post your questions anonymously, and our team will collect them throughout the presentation. So feel free to submit these questions throughout the presentation, and we'll try our best to address them on the spot after the presentation has concluded. So let's get into it then. And in terms of fund highlights, as at today's date, the net asset value, the unit net asset value of the SavInvest India Asia Fund, or SIF, was US $9.51 per unit. In terms of year-to-date highlights, Indian equities have been up 6% year-to-date, and in the past 6 months have been up in fact 24% after quite a rocky start to the year of 2016. Asian equities on average have also followed a similar trend, up around 9% year-to-date, and in the past 6 months have also advanced about 19%. Markets have responded to a measured improvement in commodity prices and a delay in US Federal Reserve interest rate hikes, which have lent a little bit more investor optimism to the outlook for global equities. What about fund performance? This graph takes a look at the SIF's net asset value movement throughout 2016 thus far. Let's take a look at it. At the start of the year, the net asset value was just around $9 per unit. And as mentioned previously, the year got off to quite a rocky start for not just the Indian and Asian region, but global equities as an entire asset class. So we could see that from the start of the year to just around the end of February, the NAV fell from around $9 per unit to just about $7.75 per unit. Subsequently, there was a rally in asset prices as markets rebounded considerably, and this rally has been sustained broadly since the end of February, early March, and into the rest of the year, with the NAV closing at its most recent level of $9.51 per unit, after peaking recently at a year-to-date high of just around $9.60 per unit. To shed some more light on the performance of Indian market relative to global markets, we take a look at the SENSEX, which is the Indian stock market index, versus the S&P 500, which many investors recognize as one of the more popular US equity market indices. And as we can see at the start of the year, again, very challenging. The S&P, as denoted by the blue line, declined some 10% at its low point in early to mid-Feb. Whereas India, in US dollar terms, that is, accounting for both market changes and changes in the value of the Indian currency, was down almost 15%. And again, as mentioned, there was a subsequent rally with both the S&P 500 and the SENSEX advancing in year-to-date in excess of around 5% in year-to-date terms. What about historically? Since 2012, that is when the fund became open-ended, the performance of the SIF has closely tracked the performance of its benchmark, where in 2012, both the benchmark and the SIF fund generated returns of around 20%. In 2013, there was some divergence where the fund declined some 8%. In 2014, the fund would have outperformed the benchmark, advancing some 12.5%. And we can see the performance in 2015 as well. Similarly, both the fund and benchmark declined some 10%. In 2016 year-to-date, the fund is up around 6% and the benchmark is up around 9.5%. So again, the fund is in general doing what it's supposed to do, which is providing investors with access to the India-Asia region and the equity markets. Since the fund went open-ended in November of 2012, you can see that the performance has been somewhat mixed, whereby, and this graph gives an idea of total returns since the fund has gone open-ended, and it would have since 2012 at a total return of around 15%, and at its current date, at current levels, it's just about break-even in terms of the $9.50 valuation. When the fund did go open-ended, it was at a value of about $9.49. How is the fund invested? This is a matter of allocation, and let's go through how the fund is invested. And as we can see, the fund is basically fully invested with just about 1% in cash. 68% of the fund is in direct equities, and this predominantly relates to the Indian region. And 52% or roughly a third of the fund is invested in equity mutual funds and exchange traded funds. And this particular investment subclass of the equity asset class gives exposure to the non-India Asian regions. And that we speak here of jurisdictions and destinations such as China, Korea, Taiwan, Hong Kong, and other Asian destinations. Again, in terms of geographic allocation, almost 70% of the fund is invested in the anchor investment destination of India, while about 11% of the fund is invested in the region of the destination, the country of China. Korea and Taiwan and Hong Kong account for 6% of the geographic allocation respectively, and other smaller destinations such as Vietnam, etc., account for just around 2% of the investment. Let's turn quickly to market and economic performance. Here we can see the performance of some major Asian equity markets in US dollar terms. That is, accounting for both the performance of the equity market as well as the impact of currency on your investments. And on a year-to-date basis, we would note that Taiwan has actually been the best major Asian equity market performer on a year-to-date basis, with about a 12.1% market advance. Korea's equity market has also been doing quite well, advancing about 9.5% year-to-date. India, the ARCA investment of the India-Asia Fund, after again the rocky start as was experienced by almost all Asian economies, has advanced 6%, and Hong Kong has advanced about 4%. Surprisingly, China, which is still growing at a reasonably fast rate in terms of real GDP growth, as we'll see shortly, has declined. Its equity market has declined just around 15% year to date. And this would have been actually a little bit worse earlier on in the year, but it would have since recovered. Let's take a look at some more economic data now, and we focus firstly on India, the anchor investment of the India-Asia Fund. And what we will note is that the fundamental growth and economic data that is coming out of India remains quite positive, which is one of the encouraging factors for Bourse as investment managers to remain quite invested in India as a destination. And if we take a look historically, from 2012 to 2015, GDP growth, or real GDP growth in India, has actually accelerated quite commendably from around 5% in 2012 to just over 7% in 2015. And this has been in stark contrast to some of the developing countries who have been growing at around 2 to 2.5%, as in the case of the US, and some other Asian economies which have actually been slowing, such as China, which has declined from around 8% growth rate to just around 6%, which is still quite impressive. Forecast growth for India in 2016 and beyond is in the vicinity of 7.5%. You see 7.4 in 2016, 7.4 again in 2017, and in 2018, growth will accelerate to 7.7%. So from a growth perspective, the Indian economy is doing quite well. In terms of inflation, this number is also headed in the right direction, whereby in 2012, inflation was at a quite high level of 9.3% and peaked in 2013 at around 11%. Subsequently, in 2014 and 2015, inflation has come down to around 6.4% and 6% respectively. And the forecast for 2016 to 2018 is an inflation level of about 5.3 to 5.2%. Why is declining rates of inflation a good thing for an economy? Well, it means that the purchasing power of consumers are not eroded as quickly, and it means that they will be able to consume more for a bigger basket of goods for the same value, relatively same wallet size. In terms of the current account, it's at a moderate 2% forecast, and it's in 2015 registered just a deficit of, in terms of percentage of GDP, of 1.1%. And India's interest rates, alongside cooling inflation, have also come down to stimulate growth, consumption, and other credit-related activity. And you can see in 2012, the benchmark interest rate in India was about 8%, and this has declined consistently to a forecast rate at the end of 2016 in the region of around 6.5%. In terms of developments in the Indian market, the recent passage of the Goods and Services Tax, or GST, improved investor sentiment in the short term, and it is also what many investors and market observers would call a benchmark or precedent in terms of paving the way for further reforms of the Indian economy. The GST, or Goods and Services Tax, is very similar, quite similar to what we would call value-added tax here, which is a consumption-based tax. And prior to the passing of the GST, there were several consumption-based taxes across many states in India. The GST seeks to unify what consumers pay when they make their discretionary purchases. And in that way, improve transparency in terms of pricing and consumption across the population of 1.3 billion. And of course, as mentioned before, in terms of developments with respect to India, India is projected to grow by about 7.5% in 2016 and 2017 respectively. Turning to China, China is the second largest economy in the world at about $11 trillion US, and the largest economy in Asia. And if we look at some of the economic data of China, what we would note is that China seems to be fading a bit relative to historical norms. And as you mentioned, in the early part of the 2000s, China was growing at around 8%. Since 2012, China's growth has slowed to around 7.7%, with a consistent slowdown into 2015 of just below the 7% marker. Growth is forecast in China, real GDP growth that is, in the vicinity of 6.5% in 2016, slowing to 6%, just around the 6% level in 2017 and 2018. Inflation in China remains quite moderate at just about 2%. Important to note that even though China's economy is slowing relatively, 6% is still quite an aggressive growth path for such a large economy, and it continues to be a major driver of growth in the region of Asia as well as at a global level. And China's demand for goods and services, materials, commodities, etc., plays an instrumental part in the fortunes of regions spanning from North America to Latin America, Europe, and other parts of the world. China is expected to have a gradual recovery as some structural reforms are put in place over time. Notwithstanding the slowing growth that we're seeing in China, the Asian region, as I mentioned earlier, excluding Japan, is still one of the strongest areas of growth at the global level. And here we can see that in 2016, global growth is projected to be around 3%, and just over 3% in 2017 and 2018. Asia, on the other hand, is projected to have growth in excess of 5.5% in 2016, eventually climbing to around 6% in 2018. This is a much sharper rate of growth than, for example, the Euro area, which is forecasted to grow just about 1.5% for the next 3 years, as well as North America, which is projected to grow just 1.5% in terms of real GDP versus just about 2% in 2017 and 2018 respectively. So again, Asia remains the basket of growth, for want of a better expression, for the region and the globe in its entirety. In terms of economic performance, as you see, growth has slowed in the Asian region, but is still well above the global average. Inflation is expected to moderate further. The current account as a percentage of GDP for the average Asian region is expected to actually improve initially in 2016 before some deterioration in 2017 and 18. And interest rates remain quite accommodative to facilitate growth and stimulate economic activity. So, having looked at growth initiatives, growth in the region, market performance, and the allocation of the fund, what are some of the outlooks for the fund and the region, as well as initiatives that will be undertaken by the management of the SavInvest India Asia Fund? Well, in terms of drivers of fund performance, we can see here that any delay or further delay in interest rate hikes by the US Federal Reserve will be a positive momentum indicator for the Asian region and, by extension, global markets as a whole. The US Federal Reserve has continued to push its interest rate hikes further and further into the future on account of weaker than expected US economic data, And this bodes well for emerging markets who tend to be impacted by interest rate hikes in the US. Specific to India, further progress of structural reforms in the country will improve or should improve economic progress and accelerate growth, and that has been reflected in the real GDP growth forecast into 2018. And of course, Asia is typified by average lower political risk as well as lower monetary policy risk relative to some of its other emerging market peers. And for example, in India, we would have noted the very positive impact of its central bank governor, Mr. Rajan, over the last few years, and the new governor of the Central Bank of India, Mr. Patel, is expected to continue in very much the same vein as the outgoing governor, given that he was the deputy governor during Mr. Rajan's reign. In terms of some risk to performance, on the flip side of delayed US Federal Reserve interest rate hikes, sooner than expected interest rate hikes, and that is if Fed Chairman Janet Yellen raises interest rates before the market broadly expects it. And here we see that it is less likely that interest rates will be raised sooner as opposed to later. Higher than expected inflation in the Asian region could be a downside factor in terms of risk to performance, and this is related to any improvements that we see in energy prices. Asia on the whole is a net importer of energy, and lower energy prices has been somewhat of a boon to the Asian region, who have benefited from lower import costs of energy, oil, natural gas, etc. Commodity prices would have also come down during the last 12 to 18 months in terms of iron ore, copper, and other industrial metals, and this would have also played a part in reducing inflation in the Asian region. In terms of execution of certain new legislation being implemented, delayed implementation of measures such as the GST and bankruptcy bills, and this relates to India specifically, and delayed passage of any further reforms could then put a dent in investor confidence. Having said this, India is well on its way to implementing GST by April 1st of 2017, which is the start of its 2017 fiscal year. So, as we come to our final slide of the presentation, in terms of strategy for the fund, it remains broadly consistent. And by broadly consistent, we mean that as a fundamental-based investment, using a fundamental-based investment approach, we continue to follow positive economic data. And as we would have highlighted in our presentation, Asia still remains a very strong region in terms of growth and development at the global level. We will maintain a country and sector selection approach whereby we favor countries with higher levels of growth, as we would have seen in our geographic allocation within Asia, whereby India has the highest level of growth and would have allocated the heavier weighting of our portfolio to India. And of course, the benefit we would remain fully invested. The data that we continue to receive from the Asian region encourages us to remain positive on the region and adopt a fully invested approach as to perhaps a conservative approach which may be warranted in other regions. With that being said, this brings us to the end of the official presentation of the India-Asia webinar, and we would now be moving to our question and answer session. And I would like to invite once again our Managing Director, Mr. Subhash Ramkilao, to join as we answer some of the questions which may have been presented to us during the course of the chat.
Thus far. So let's turn now to some of the questions which have come to us and which I expect will come to us during this particular session. Of course, the first question is, why has the performance of the fund been muted in recent years? Well, the answer is that the economic performance globally has been weak, and in particular, there has been some sort of disconnect between economic performance in some areas and market performance. And much of that has been due to, across the world, monetary incursions that have distorted the fundamentals of these various regions. That is being clawed back, especially as we've started in the US, where the whole question of monetary stimulus is being reduced, if not eliminated, in the form that it took post the 2008 financial disturbances. Now, as to the first question of what has caused the performance to be muted, economic factors, yes, but also what you would have seen, monetary factors across the world. Now, what has changed is that in the first couple of years, in 2012 onwards, oil prices were high. Those prices have come down, and net importing countries have benefited. India is one such country, as well as most of Asia, which are net importing countries. And we've seen the impact of this having a positive impact in terms of economic growth. To some extent, it has not fed fully into the markets, and we believe that over time, this is going to feed into the markets and give the market impetus and drive that you can expect to see. Our outlook, as you would have seen in the presentation, is a positive outlook for the India-Asia region in which we are invested and fully invested. There are other factors, and those other factors we will address as we go along in this question and answer session.
We have another question. What do you expect from India and the rest of Asia going forward?
Well, the presentation has shown the outlook for India in terms of economic growth. Outlook for the rest of Asia in terms of economic growth, as you would see, compared to the rest of the world, it's 6% in the case of Asia ex-Japan, versus the rest of the world. When you look at the US, expectations are about 2% or less, and Eurozone even lower at 1.2 to 1.5% over the next couple of years. This will feed into market valuations. This will feed into corporate earnings, and this will therefore impact what is happening across the board. Expectations, India is, as I said before, the brightest spot amongst the large industrialized countries, with growth expected in the vicinity of above 7%, 7.4% or thereabouts, and this will feed into the performance, we believe, in the Indian markets.
Additional questions. Firstly, what effects would the Olympics have on the India-Asia market and by extension the India-Asia fund?
Well, I don't think that there would be much of an impact in terms of the Olympics on the Indian market. If anything, that might affect the Brazilian market, but the Indian market not so. That they have won, I think it is 2 medals, none of them gold, doesn't really mean much on a comparative basis for India, because India has never been a strong competitor in the area of track and field or other sports at the Olympics. I can't think that their record has been much more than what has happened in this particular Olympics. So nothing there. Maybe Brazil will be more impacted because the Olympics were hosted in Brazil.
Okay, yeah, an additional question. When does the fund expect to pay a dividend?
The question of a distribution is always linked to the NAV of the fund. Our approach has been to pay a dividend or a distribution when the fund surpasses its initial issue of $10. The fund is still slightly below the initial issue price of $10. That is in the first tranche of fund. As you know, some of you may recall, the fund started at $10 and went up to as high as $16, and then markets were compromised by what took place in terms of the greatest financial depression that we've had in the 2007, 2008, 2009 era. So that the whole question of the fund's performance and the payment of a distribution is hinged on the surpassing of the $10 figure, which we strongly believe will take place if the fundamentals, which we are seeing as very strong, feed into the market. Political stability, one; the economic fundamentals, two; the change in the fiscal regime, with GST, which is comparable to our value-added tax in some ways, should generate additional income for the country, but will also at the same time produce in many of the sectors higher corporate income because of lower taxes by certain sectors in the main. And therefore, we are very optimistic and positive about the outlook for the Indian market. Of course, in some other areas, as we have said before, the Indian investment allocation is 70%, and then the rest of Asia, it's about 30%, with China being about 10 or 11%, Taiwan and being 5 to 6%, as it fluctuates over time, as you would have seen on a previous graph. So the fortunes of India are pushing upwards as far as the market is concerned. China is down, as you would have seen, some 15%, but it's not the largest part of the pie. It's a smaller part of the pie. And therefore, these factors will drive, I think, performance, one, and valuations of your fund.
This is a two-part question. One, when do you expect the NAV to increase? Well, this may have been addressed, but the second part is why should an investor stay invested in the India fund?
Well, I think this question has been asked in different forms over time. But we have said consistently, do not put all your eggs in one basket, meaning that a key element of investment is diversification and proper allocation of your portfolio. As you look across the world, Asia is an extremely important part of generating returns. It is very well placed to continue to generate high returns, and the outlook is for, shall we say, better returns, better market opportunities compared to the rest of the world. One indicator, economic growth. We've spoken about that ad nauseum. Asia provides the highest level of economic growth going forward over the next 3 years, compared to the US, compared to Europe, as I've mentioned before. And even looking at the contribution to the global growth, India stands out, and some other Asia countries stand out. And that's why we continue to say that India is now the brightest spot in terms of economic outlook for the large industrial countries.
One more question so far. And we encourage everyone, please feel free to submit your questions. They will be brought anonymous to the entire webinar attendee list. And any question that you wish to submit would be quite welcome. So the last question that we have received so far is, what is being done to provide better returns for the fund?
Again, similar to the discussions that we've had before, better returns for the fund will, since this fund is focused on India, Asia, this is the region that we continue to invest in. And therefore, it is about the asset mix, it is about portfolio allocation in that area. Having seen India as the significant bright spot in economic terms, we have invested fully based on our internal allocations up to what I would consider to be at or near the limit of the mix between India and the rest of Asia. And therefore, our strategy is to stay invested with the strong outlook that is in place for India. We have invested in other parts of Asia, ex-Japan, and you see that on your screen. China has been somewhat disappointing as it has trended down thus far this year. And while it is down percent, recall in January, February of this year, it was even at a lower clip. But the market has recovered and recovered well, but China is still underwater at negative 15%. Other areas, Korea, Taiwan, Hong Kong, have done quite well and are in fact on par with India at that 6% appreciation since the beginning of the year, notwithstanding the significant downside that took place in January and February of this year. So the moral of the story is diversification, and for us to reflect that in India, Asia, it is about our portfolio allocation. We think that we have gotten it to the right sort of mix that we need to have at this point in time, and we are going to stay within that portfolio mix unless there are significant changes in the economic outlook for countries in the India-Asia region.
Just one point of clarification. One of the earlier questions about the Olympics actually related to the Tokyo Olympics, and well, it was mentioned that we're not invested in Japan. So the question was actually based on the next Olympics in Tokyo, not Brazil.
Yes. Well, this fund, as I said, is focused on India, Asia, ex-Japan. Over time, we will consider other funds which will have a higher proportion of Japan, probably funds such as China Pacific, which would include Japan. However, given the performance of China over the last year or two, I think there is need for some stabilization of that particular area before we look to move forward. Japan itself has been in economic stasis for several years. So I don't think that necessarily you are going to get the kick that you want in Japan. Let me just put it into context. When we went into the Brazil Latin Fund, another fund which is sponsored and managed by Bourse, the Bourse Brazil Latin Fund, much of the hype and the confidence was that Brazil in 2014 would host the World Cup, and thereafter, as it recently did, host the Olympics. But other factors have predominated. Other factors, in particular the political situation, as well as the economic downslide caused, as many experts have suggested, primarily by the slowdown in China, which was the biggest area of demand for commodities, and it impacted across the board many of the LATAM countries, and in particular Brazil, the largest economy in LATAM. So Olympics or no Olympics, the moral of the story is that the fundamentals must continue to remain strong. And if that is not the case, it will, whether delayed or anticipated, it will impact markets. I don't see then necessarily that going to Tokyo or going to Japan will make, I say this advisedly, too much of a difference to the portfolio investor. Be invested, be diversified. Sometimes markets will go up, sometimes they will go down. If you are diversified, it is not the case that all of them will go in the same direction at the same time. So we have covered, in particular, my sense is that the concern of investors has been, when will the fund generate higher returns? We've tried to address that question. What is our outlook? We have addressed that question. Very positive going forward, because the main driver in this fund is India, and the fundamentals are strong, and there is good stability in the region. So as we think about where we go next and how we go next, there are other things that Bourse is going to be providing to the market, depending on approvals and so on, as we go along over the next year or so. Look for these areas. I believe that in terms of diversification, we can provide vehicles for you, not only to get into regional spaces, but also to get into asset classes. In particular, what we have seen is that the bond markets have performed very well, and very well for persons who are interested in holding their assets to term, bond assets that is, so that you credit being held constant. What happens is if you hold and you go out for a longer period, you get a higher return by staying invested. And we have been able to provide investors who hold to maturity, and again, subject to credit, we've been able to provide them over the term to maturity of these bonds returns in excess of 5%. And so we encourage investors to look at other approaches to investing, not only by regions, but also by various asset classes. And this makes, I think, very good sense for the investors. So there being no other questions at this point in time, we strongly encourage you, if you have additional questions that you do not want to field at this time, please send them in, and we will continue to address them with you on a one-on-one basis and across the board, so that you can feel comfortable with the information that we are providing. As you have on your screen, again, email us at investment@boursefinancial.com or sales@boursefinancial.com. Look to our website, where we post on a daily basis all our funds, whether under the rubric of Bourse or under the rubric of SavInvest. These are all the funds that we manage, and you can see that daily on our website. Call us if you have the need to raise questions, and at 628-9100, and one of our investment advisors will be able to address your questions. So this brings us to the conclusion of our presentation with you today. I encourage you to continue to stay invested, stay diversified, and as you steer that course, the results, I believe, are going to come to you as the markets start to change, economies change, and the outlook changes for different jurisdictions and different asset classes. This has been our webinar presentation. I want to thank my colleague Sarod Ramkilawan, and on my behalf, the team at Bourse, to wish you excellent investing. Have yourself a wonderful evening.